Credit scores, why are they so important to you getting a loan? Let's talk about it. The credit score is used along with other guidelines to determine whether you can get a loan and what interest rate you're going to get a loan for. So lenders look at your credit score, they pull your credit report, and they use it to determine, based on guidelines, what you can get approved for as far as interest and which loans you can look at. There's credit scores that are being used as low as 540 in some cases, and they generally are looking at 620 and above, but it's all about talking with a lender, and they'll discuss what options you have based on your credit score and what you're trying to do. They will walk you through the process. This is an educational video to help you understand how they come up with your credit score. So we're going to talk about 3 factors today: your credit history, your credit utilization, and the length of your credit history. So 35% of your score is made up by your credit history. Are you making payments on time? Are you making late payments? Have you missed payments? Is there something that you let go back, like you bought a car and it had to be taken back? Bankruptcy and things like that will affect your credit. There's time limits for how long things will be on your credit when something like that happens. So by pulling the report at least once a year, it can help identify things that are negatively impacting you, as well as things that you could take care of that maybe there's just made a mistake. Things like identity theft can be identified by pulling your credit report, because someone could be opening up lines of credit and things like that in your name that you don't even know about. So it's good to pull your credit report from the 3 major credit bureaus at least once a year, because it is free to do so. So that's the first 35% is your credit history. So knowing what's impacting and trying to take care of the things that you see on there is one of the first steps to assessing your credit. The next thing to think about is credit utilization. So that basically is just saying, how are you using your available credit? If you have, for example, a $5,000 credit limit, do you have that full $5,000 maxed out? Month over month, are you just making minimum payments? Or, for example, let's say you had $4,500 used of the $3,000. It looks like that credit card is helping you live month by month. That without that, you're not able to make your payments, and they don't want to see that. They want to see that you're able to pay it off each month or pay it down each month, that you're not dependent on that line of credit to be able to make all your payments, that you're living paycheck to paycheck. Because at the end of the day, they're assessing risk. So who would you rather lend money to? Someone that at the end of each month, they are paying off their credit card that they're using to accumulate points and to build their credit, or someone who has it maxed out, that they're making $25 payment each month, and it looks as if without that credit card, they wouldn't be able to make it to the next month without being delinquent on their bills. So it's all about assessing risk. They're lending money out, they're expecting it to get back. It's all a business transaction. So after credit utilization, which makes up the next 30%, the next thing to discuss is the length of your credit history. This is important, and this is one that a lot of people don't think about. I know I didn't when I was younger. That I had when I went to buy my first house, for example, I had good credit, but however, I had never had a car payment. I had always bought things in cash. And so that hurt me, because yes, my score number was good, but my credit history, there wasn't much there. I had a department credit card at the time, and I hadn't used it a whole lot, and I never had any car payments or anything like that. So I didn't have a lot of things showing a history of me making payments on time, not missing payments, paying off loans, things like that. So I couldn't be primary on the loan that I was on, because at the end of the day, they didn't have enough history to look at when they were assessing my risk. So how long has your longest line of credit been out for is a big factor, and how are you using it? How long has it been since you used it last? So if you have a department credit card and that's all you have, and you haven't used it in 5 years, that's not much of a history. Yeah, you're not missing payments, but you're not using it either. So it doesn't give them much of a history, letting them know that you're responsible with your payments, that you're going to pay stuff back on time. Because a little secret that some people don't know, when you're trying to raise your credit is you could add yourself to a family member's credit card, for example, that has a long established history, and it'll help bump your credit score up because it's adding to that history of good payments, someone making good payments. So that's one thing that people recommend if you're trying to boost your credit up. That's something you can do. And so the length of the credit history that you have and how you use it makes a big impact. And those three categories alone make up 8% of the total picture when they're looking at your credit score. So it's important to take these factors into consideration and to understand your credit score when you're going to get a loan. As far as what number is good when you're looking to get a house, there's loans out there and programs where people are able to get in with a credit score of 540. It's not as common that it's being used, but there are programs out there. Usually they're looking for 620 and above. And so how are they using it? They take and there's a chart that based on your credit score that you have, they take and put you on this chart and say, okay, for this credit score, we're going to have to add this percentage to the total base percentage that we're using. So it's going to cause you to pay more interest over time, and for the life of the loan, you're going to pay more than someone with a higher credit score. However, recently the government has released things where there are programs out there where they're not having to add as much of a percent for some lower credit scores in some cases. It's all about talking to a lender. They're going to walk you through the process. They're going to try to do what's best for you as far as to get you the most you can get for your pre-approval. So in future videos, we'll go on in the process and talk about pre-approval. This is video number 3 in a series where I'm walking people through of things to consider when buying a house in 2023 and going forward. So it's about information and understanding, so that way you can plan and position yourself to get to where you want to go. I know things are a little bit tighter than what people have seen in recent years, but it's all about being educated, and when it's your right time to buy, you want to put yourself in the best position to be able to do so, or have that plan in place to get you there down the road. So if you like educational videos like this, my name is Mark Melendez with Tina Hearn Realtors. I'm going to continue to put out information like this, so just like and share this information to anybody who might be interested, and also ring the notification bell and stay tuned for new videos coming forward. Hope everyone looks forward to educating themselves about the home buying process.